Welcome to the Deep Dive, the show where we take a stack of fascinating information and transform it into the essential knowledge you need to be truly well-informed.
Wow.
Today, we're diving into a story that has quietly, yet profoundly, reshaped the very backbone of our modern digital lives. I mean, think about your own internet use in the last decade.
Oh, it's exploded, hasn't it?
Absolutely. From binge-watching 4K streaming to holding down a full-time job from your spare bedroom, your connection needs have gone from, well, basic browsing to mission-critical infrastructure.
Right. And this system delivering all of that, it simply had to change. It's this invisible force, isn't it, underpinning everything we do online?
Streaming, video calls, social media, it all relies on this physical network under our streets or maybe overhead, and it's gone through this almost revolutionary transformation.
Yeah, a huge shift.
Exactly. And our mission today is to unpack the core of that transformation, the dramatic strategic pivot of the U.S. telecommunications industry from its familiar legacy copper network
The ones we all grew up with.
to a massive, widespread fiber to the home, or FTTH, infrastructure. We're going to explore why this profound shift happened.
Looking at all the different factors, yeah. Market forces, tech changes.
Economic realities, government policy. It's a complex interplay. It's really a compelling story of how a business case, which, seemed financially impossible for decades,
Absolutely untenable.
suddenly became an existential imperative for these massive companies.
And to guide us through this, we've gathered a pretty comprehensive set of sources. We're drawing from in-depth industry analyses, detailed financial reports from the big carriers themselves, and key policy documents.
So we can piece together a full detailed picture of this monumental rewiring of America.
Hopefully, yeah.
Okay, so let's unpack this incredible shift. And maybe we should start with a somewhat counterintuitive fact. For the first 2 decades of this century, the major U.S. telecom carriers largely avoided big FTTH investment.
Right. It wasn't like they didn't see fiber coming.
No, it wasn't a lack of vision. Our sources call it a rational response to some incredibly formidable barriers, which explains why, for many of us, our internet speeds felt kind of stagnant for a long time, didn't they?
Stuck in a rut before things suddenly took off.
Yeah. This era of hesitation really holds the key. So what made them so reluctant back then?
Well, primarily, it boiled down to what was, at the time, just a profoundly unfavorable business case. I mean, the sheer capital expenditure, the CapEx, the money needed upfront.
Yeah.
It was just prohibitive. Early reports, going back to maybe 2001, 2006, they estimated the cost to pass a single home with fiber. And this was for a triple play system, voice, video, data.
Right.
It ranged from maybe $1,800 to $2,100 per household.
Per home. That's huge.
And even more recent analysis, adjusted for inflation, shows burying fiber could cost up to $2,500 per household. Plus, you've got maybe another $5 per foot just for the trenching.
Wow. So these figures, they represent an enormous hurdle.
Massive.
And just to put that into perspective for you listening, this wasn't like swapping out your router.
No, not at all.
This was more like rebuilding the entire street's utility infrastructure right to your house. It was essentially a near total rebuild of that critical last mile of the network.
Exactly. Requiring extensive civil works.
Yeah.
We're talking digging trenches, boring under properties,
Yeah.
stringing entirely new cables on poles.
It's a full-scale construction project. For every single home they wanted to connect.
Right. And those huge costs, they translated directly into incredibly long and frankly uncertain payback periods. The time it takes for a company to actually get its money back.
How long are we talking?
Well, an RBC Capital Markets report from 2015, looking at a similar market, calculated an 11-year discounted payback period. And that was for the easier aerial builds, stringing cables on poles.
11 years just to break even, essentially.
Yeah, and in more challenging scenarios like dense cities or difficult terrain, that stretched to a daunting 18 years. For the more expensive buried builds, maybe 13 years. Some analyses even suggested 15 to 20 years.
20 years.
Yeah.
Wow. Now, in the world of Wall Street, where the focus is often, let's be honest, relentlessly on short-term shareholder returns.
Quarterly earnings, dividends, buybacks.
Exactly. Committing billions to a project that might not show a profit for a decade or two, maybe even longer. That was just fundamentally misaligned with their priorities, wasn't it?
Completely. It wasn't that capital was scarce, per se,
Okay.
but it was being strategically allocated elsewhere to a different, much more immediately lucrative sector.
Which was?
Wireless. Mobile. I mean, the period from the late 90s through the early 2010s was the absolute golden age of mobile expansion.
Everyone was getting a cell phone.
Right. Wireless subscribers in the U.S. surged from maybe 28 million in 96 to over 170 million by 2005. That explosive growth, plus the upgrades to 3G, then 4G LTE.
Required huge investment.
Enormous, continuous investment. If you look at the data from 2015, wireless providers accounted for something like 43% of the entire industry's capital spending. That's way more than the 35% for wireline.
So it was a conscious choice.
It was, as our sources put it, a calculated judgment on the most profitable use of the next dollar. They just saw a clearer, faster return in mobile.
So instead of pouring money into this, risky long shot fiber bet with decades-long returns, they doubled down on the proven winner, wireless.
Makes sense from their perspective at the time.
But this brings us to another fascinating barrier, the stranded asset dilemma. They were, in a very real sense, kind of shackled to their existing copper infrastructure, weren't they?
That's a really good way to put it. Shackled. The legacy copper plant wasn't just old. It was a financial anchor. It was aging. It was expensive to maintain.
Lots of repairs needed, I imagine.
Constantly.
Yeah.
And it was serving a dwindling customer base as people switched to cable broadband or just used wireless for everything.
So it's a paradox, right? Maintaining copper was costly, but replacing it with fiber was seen as an even greater financial burden.
Exactly. Damned if you do, damned if you don't for a long time. And to add insult to injury, the physical copper itself became a liability. Our sources talk about a crisis of theft.
People stealing the wires.
Yeah, the rising market value of the metal led to criminals literally cutting down and stealing copper wires. This caused service disruptions and sometimes even damaged adjacent fiber lines they were starting to put in.
Wow. Okay, here's where it gets really interesting, digging into the regulatory and accounting side. Our sources detail this critical nugget. Existing frameworks actually played a significant and maybe somewhat perverse role in discouraging fiber investment. Tell us about that weird IRS ruling from 2011.
Right, this is a fantastic detail. Really shows the hidden incentive. So first, you had NTIA guidance assigning a 20-year depreciation schedule to copper wire. Its value stayed on the books for decades.
Okay.
But the really kicker, the perverse financial incentive, came from a 2011 IRS revenue procedure. This guidance basically allowed carriers to treat all the copper wire and any associated devices in a wire center as a single chunk, a single unit of property for tax purposes.
That sounds arcane. What did it actually do? How did that rule discourage new fiber?
It had profound consequences. Because when a portion of this big single unit of copper failed, say, one line to one house needed, replacing its replacement could often be classified as a repair.
And repairs are?
Repairs are operating expenses, OPEX, which means they could be immediately deducted from taxable income, lowering the company's tax bill right away. A nice quick benefit.
Ah, okay. But putting in new fiber?
That was totally different. Deploying a new fiber optic line was unequivocally a capital improvement. Its cost had to be capitalized, put on the balance sheet, and then depreciated slowly over many, many years. Much less attractive from a near-term tax perspective.
So it created this powerful disincentive. It was actually more tax efficient to just keep patching up the old copper.
Exactly. It was more tax efficient to continuously patch and sweat the legacy copper asset, as one source puts it. Made it financially logical, even if strategically questionable long-term, to keep that old infrastructure limping along.
Literally incentivized to keep the old rusty thing going. Meanwhile, the market itself wasn't exactly screaming for fiber yet, was it? It was kind of a good enough network situation for a long time.
Precisely. This led to that period of stagnant technology and pretty limited competition, relatively speaking.
So what did this good enough actually look like for consumers?
Well, to compete with cable providers, who definitely had a head start with their hybrid fiber coaxial networks, the incumbent telcos invested in incremental DSL upgrades, often called fiber to the node, or FTTN.
So fiber part of the way, then copper the rest.
Exactly. Run fiber deeper into neighborhoods, maybe to a local cabinet on the street, then use the existing copper lines for that final, shorter run into the home. They use technologies like VDSL2 and vectoring fancy signal processing to squeeze more speed out of that old copper.
Like AT&T's U-verse.
That's a prime example. U-verse relied heavily on FTTN. They offered, remember, an Internet 45 millipiece tier by bonding two copper pairs together. It was seen as a capital-efficient path, a way to compete without that massive, costly fiber overbuild.
Right. And while the telcos were stretching copper to its limits, the cable companies were sitting pretty, relatively speaking, with their HFC networks.
They were the clear leaders for a while. Their DOCSIS platform data over cable service interface specifications, specifically versions 2.0 and 3.0, allowed them to offer speeds of 50, 100, even more Mbps. And crucially, it was much cheaper and faster for them to upgrade to SCSS than it was for telcos to upgrade DSL.
And for most people back then, say before 2015, those speeds felt pretty fast, right? Even if the upload was slow.
Yeah, those asymmetrical speeds, high download, lower upload, were generally more than adequate for what people were doing. Streaming a single Netflix video, browsing the web. If you look at Table 1 in our sources, comparing the costs, speeds, payback for FTTH, FTTN, and DICSS 3.0.
What was it, Cha?
It's pretty clear. FTTT had the highest cost, longest payback. DOICS 3.0 offered the shortest payback for upgrades and delivered good enough performance for the time. Made sense for them to just keep upgrading to OCSS.
And critically, consumer demand just wasn't there yet to justify this huge leap to fiber everywhere.
No, not really. In the early 2010s, the sources say the digital world was simpler. In 2010, about 68% of U.S. households had broadband, but the average advertised speed was only about 7 or 8 millipedes.
That seems so slow now.
Doesn't it? And get this, the median user back in 2009 consumed just under 2 gigabytes of data per month. That rose to 9 gigabytes per month in 2010. Pocket change compared to today.
So there were just no mainstream applications that truly needed symmetrical gigabit speeds.
Exactly. So the limitations of copper weren't yet a widespread consumer pain point. It was a classic chicken and egg situation. No demand, no build, no enabling of new demand.
On top of all that, there were these significant regulatory and structural hurdles. Just getting shovels in the ground sounded like it was a nightmare.
Oh, absolutely. Imagine trying to dig up streets or string cables across thousands of different towns and cities.
Yeah.
Each with its own permitting rules, its own right-of-way negotiations.
A bureaucratic maze.
Totally.
Yeah.
It was incredibly complex, time-consuming, and expensive. Google Fiber, actually when they first started, had to develop an internal city checklist just to help municipalities streamline these barriers. That underscores how real and impactful these obstacles were. It wasn't just money. It was navigating this labyrinth.
And then there was the long shadow of the Telecommunications Act of 1996. How did its unbundling mandate specifically discourage fiber investment?
Ah, yes. The 96 Act, its unbundling mandate, Section 251 specifically, forced the incumbent local exchange carriers, the ILEs, the traditional phone companies, forced them to lease parts of their network, especially those copper local loops going to homes to their competitors. These are the CLECs, competitive local exchange carriers, and they had to lease them at regulated cost-based rates called TELRIC pricing.
TELRIC, total element long-run incremental cost.
Sounds complicated.
It is, but the effect was simple. If I'm understanding this right, the very law designed to promote competition actually created a huge investment disincentive for the companies who own the networks. That's exactly it. It meant the ILCs, the incumbents, bore 100% of the risk and cost of building any new network like fiber. But if that network was successful, they were legally required to share the upside by leasing access to competitors at these low regulated rates.
So it destroyed the business case.
Pretty much. It significantly diluted the potential return on investment for building new fiber. If you look at Table 1 in our sources on FCC regulatory milestones, it really illustrates how these actions dampened investment incentives.
And wasn't there also the threat of net neutrality rules?
Yeah, plus there was always that looming threat of net neutrality regulations under Title II classification hanging over them. Industry analysts at the time predicted Title II would have a profoundly negative impact on capital investment, which further chilled any desire to commit billions to new fiber infrastructure.
Okay, so for years, sticking with copper, doing incremental upgrades, it was a perfectly rational, if maybe ultimately short-sighted business decision.
It made sense on paper given the constraints. But then something shifted, dramatically. A powerful confluence of forces started to dismantle these deep-seated barriers.
The dam broke, basically.
Yeah, leading to what we now call the fiber gold rush. Around 2015, that whole calculus we just discussed irrevocably shattered. What was the first big catalyst, the most fundamental one?
Well, the first and most undeniable force was just an explosion in bandwidth demand. Suddenly, good enough became totally insufficient, almost overnight.
And the main driver was?
Streaming video. The mainstream adoption of over-the-top OTT video services, Netflix, YouTube, Hulu, they went from niche to dominating how people consumed entertainment.
And that uses a lot of data, right?
A ton. Streaming HD video eats up around 3 gigabytes an hour, 4K Ultra HD, that could be up to 7 gigabytes an hour. Now, picture households with multiple smart TVs, tablets, phones.
Everyone's streaming different things at once.
Exactly. Simultaneous HD streams became common. That pushed bandwidth needs way beyond what older DSL or even those shared cable networks could reliably handle, especially during peak hours. Cisco even forecasted video would be 82% of all IP traffic by 2022.
82%. And it wasn't just streaming, was it? Overall data use just went through the roof.
Completely. This data comparison is genuinely shocking. The average U.S. household data consumption. Remember, we said it was 9 gigabytes a month in 2010.
Yeah.
By the fourth quarter of 2023, it was 641 gigabytes per month.
Whoa. That's, what, a 70-fold increase?
More than 70 times.
Yeah.
In just over a decade. And projections estimate it'll blast past 1 terabyte, that's 1,000 gigabytes per month by 2028. This exponential growth just made older networks totally inadequate.
And if streaming was the initial shock, then COVID-19, that was like pouring gasoline on the fire, right?
Absolutely. The pandemic acted as a massive unplanned stress test on these networks. Suddenly, your home internet wasn't just for fun. It was deemed critical infrastructure.
Everyone working from home, kids doing school online.
The abrupt, massive shift to remote work, virtual schooling, telehealth, homes became simultaneous offices, classrooms, clinics, all needing robust connections.
Did that specifically highlight weaknesses in the older copper or cable tech?
Oh, absolutely. It critically highlighted a major weakness of those asymmetrical networks. The upstream traffic, your upload speed.
Ah, because of video conferencing, Zoom calls.
Exactly. Platforms like Zoom created this huge surge in data leaving the home, not just coming in. ISPs saw unprecedented 20–40% growth in both downstream and upstream traffic during peak hours. Video conferencing alone jumped 300%.
And fiber, with its equal upload and download speeds.
Fiber's symmetrical capacity was uniquely positioned for this new reality. Its value became incredibly tangible to millions of people suddenly reliant on stable, two-way video communication.
So the pandemic really cemented this idea that fast, reliable, symmetrical connections weren't a luxury anymore. They were a necessity. Did that change how much people were willing to pay?
It certainly seemed to. As broadband quality became non-negotiable for daily life, the willingness to pay a premium for it increased. A 2021 survey found over 75% of people would pay more for fiber.
How much more?
A majority were willing to pay at least an extra $10 a month. Another study showed 63% of all U.S. consumers, including over half of existing cable users, considered fiber the best for speed and reliability.
So that created a clear path for carriers to boost their revenue per user, their ARPU, by selling higher margin fiber plans.
Precisely. The demand was finally undeniably there.
Okay, so demand exploded. But that wasn't the only thing that shattered the old status quo. What about the competitive landscape? Did anyone really shake things up?
Ah, yes. That's where the Google fiber effect comes in. Now, Google's actual physical footprint remained relatively small, only in select cities.
Right, it wasn't everywhere.
But its entry into the broadband market, starting around 2010, had this outsized psychological impact on the entire industry. By offering symmetrical gigabit per second speeds a gig up, a gig down for around $70 a month, Google Fiber fundamentally reset consumer expectations. It showed people what home internet could be.
So its real impact wasn't just stealing a few customers. It was forcing the entire industry to raise its game. Is there proof of that?
There is. Our sources cite an Ookla study. They're the speed test people that found a year after Google Fiber launched in Mesa, Arizona, the median download speed across all wired ISPs in the city jumped by 50%.
50%, just because Google showed up.
It clearly shows how incumbents like AT&T and Comcast were suddenly forced to respond. Doing nothing became a far bigger risk than the high cost of building fiber, because Google had just demonstrated the possibility and desirability of gigabit speeds.
And it wasn't just Google stirring the pot, right? Did the big cable companies also jump into fiber?
Absolutely. Major cable companies, seeing the writing on the wall about the long-term limits of their own HFC networks, started building their own all-fiber networks too, especially in new developments.
So it became fiber versus fiber.
In many areas, yes. This created a direct fiber versus fiber dynamic, which really made the telco's stopgap VDSL2 upgrades look obsolete as a long-term strategy.
And then there were other players, too.
Yeah, you had the rise of municipal broadband networks. Chattanooga, Tennessee is the famous example. They became the first provider to offer gigabit service to their entire city back in 2010.
A city doing its own internet.
Right. And municipal offerings grew like crazy, over 600% between 2018 and the early 2020s. Plus, you had a new wave of private equity-backed overbuilders entering the market, targeting specific regions, and really shattering that traditional cozy duopoly in many places.
So lots more competition.
Lots more. If you look at Table 2 in our sources, the timeline of key events, you see Google Fiber in 2010, faster streaming tech in 2013, faster cable tech in 2014, mobile data exploding in 2015, then COVID, massive federal funding. It all just converged around 2015 and accelerated like mad.
Which brings us to maybe the most critical shift, the economics. The whole equation just inverted. It sounds like technology, costs, and capital all suddenly lined up in favor of fiber. How did that happen?
It's fascinating how it all came together. First, the core technology itself, passive optical network or PON, evolved rapidly.
Yeah.
We went from early standards to GPON, gigabit PON, and then to XGS PON, which can do symmetrical 10 gigabits per second.
10 gigs.
Yeah. It's like a Moore's law effect for fiber optics.
Yeah.
The capabilities of the electronics at both ends of the fiber, the OLT in the central office, the ONT at your home, increased dramatically while their cost kept falling.
So lower cost of ownership, higher potential return for each fiber line.
Exactly.
Okay, so the gear got cheaper and better, but what about the really expensive part? Digging trenches, stringing lines. Did those deployment costs also come down?
They did, generally speaking, over that period. While there have been some recent inflationary pressures, the overall trend through the 2010s was towards greater efficiency. New construction methods, like micro-trenching. It's where they cut a very narrow, shallow slot in the pavement or ground, laid a fiber conduit, and then quickly backfill it. Much less disruptive and faster than traditional big trenches. That, plus automated network planning using sophisticated software, it helped reduce those labor-intensive civil works costs.
Which were historically the biggest chunk of the budget.
Right. And here's a key data point. 4 major telcos averaged a cost of around $1,195 to pass a location with fiber in 2023.
Right.
That's a significant reduction from those $2,000 plus figures we talked about from the previous decade.
Okay, so cheaper build, cheaper to equip. What about the money itself? Did the financial environment become more favorable for these huge long-term projects?
It really did. The era of historically low interest rates after the 2008 financial crisis made borrowing the billions needed for these multi-year fiber builds much cheaper.
Lower cost of capital.
Exactly. And at the same time, you had institutional investors think huge pension funds, insurance companies desperately searching for stable, long-term, inflation-protected returns in that low-yield environment.
And they landed on infrastructure.
They start seeing digital infrastructure, like fiber networks, as highly attractive. Because of the predictable cash flows, the essential nature of the service, it looked like a safe, solid bet.
So this created a big pool of available money.
A deep pool of private capital, as the sources say, eager to partner with carriers or fund new entrants. Assets under management in infrastructure grew something like 16% per year, surpassing $1.1 trillion.
Wow. Did this lead to new ways of funding these builds?
Absolutely. It allowed for innovative new ownership and revenue models, like joint ventures. A prime example is Gigapower. That's a JV between AT&T and the private equity giant BlackRock to share the capital cost and the risks.
Spreading the bet.
Right. And we also saw the rise of open access networks. That's where a neutral company builds and owns the physical fiber and then leases access to multiple different retail ISPs who compete for your business. Separates the expensive infrastructure ownership from the retail side.
Interesting model. And finally, rounding out this perfect storm, there was a major policy push. The government stepped in not just as a regulator, but as an active investor.
Yeah, this was a real paradigm shift. We saw direct federal funding programs kick off. First, the Connect America Fund, or CAF, then the Rural Digital Opportunity Fund, RDOF, that allocated about $20.4 billion over 10 years.
It was serious money.
It was. But then came the big one, the historic $42.5 billion Broadband Equity Access and Deployment Program, BEAD, part of the 2021 Infrastructure Investment and Jobs Act.
$42 billion.
It's the single largest federal investment in U.S. history, specifically for broadband. These programs were absolutely critical in de-risking deployments, especially in high-cost rural areas where the pure market economics just didn't work, made them financially viable.
And it wasn't just handing out cash, right? Were there other policy changes that helped smooth the path?
Yes, definitely.
Yeah.
There was also a big push for streamlined permitting and deregulation. The FCC worked on simplifying utility pole attachment rules, making it easier and cheaper to string aerial fiber.
Cutting red tape.
Pretty much. And at state and local levels, Dig One's policies gained traction. The idea is, if you're already digging up a road for, say, water pipes, you put in broadband conduit at the same time. Saves huge future cost and disruption.
Makes sense.
Plus, the Infrastructure Act included provisions aimed at preventing digital discrimination, trying to ensure more equitable access. If you look back at Table 2 in our sources comparing the economics pre and post 2015, the differences in cost, payback, funding, the government's role, it's just night and day, a complete inversion.
So we've got exploding demand, fierce new competition, much better economics, and significant government support all converging. What has been the actual tangible impact on the industry and maybe more importantly on the services you get as a consumer?
That really is the bottom line, isn't it? We've truly moved into what our sources call the new economics of connectivity. That old unfavorable business case for fiber, it's been completely rewritten. Fiber is now seen as a primary engine for growth. The shift is dramatic.
Okay, let's dig into that modernized business case. How specifically has fiber improved things like ARPU, average revenue per user, and customer lifetime value? Are customers paying more and staying longer?
That's a core part of it. Fiber customers are just demonstrably more valuable. They readily sign up for higher speed tiers, which obviously carry higher price points and better profit margins.
Yeah.
That boosts ARPU.
Any examples?
Sure. Frontier Communications, in their Q1 2024 earnings, reported their first year-over-year revenue growth since way back in 2015, and it was driven almost entirely by a 24% jump in fiber broadband revenue and strong ARPU growth from those fiber customers.
Wow, turning the ship around.
And AT&T, same story. Their Q3 2024 earnings highlighted nearly 17% growth in fiber revenue as a key driver of their overall profit growth, their EBITDA. It's clearly moving the financial needle for them in a big way.
And it's not just about getting more money each month, right? Does fiber affect customer loyalty?
Churn. Exactly. Fiber customers are also significantly more loyal. The superior reliability, the consistent performance, you just don't get the same congestion issues as you can with shared copper or cable networks.
Less frustration.
Way less. And that leads to significantly lower customer churn. People stick around longer, which directly increases their lifetime value at the company and cuts down on the expensive process of constantly acquiring new customers to replace those who leave.
Our sources have a table on this, right? Comparing fiber to copper DSL.
Yeah, Table 3 really drives this home. It shows specific ARPU figures, churn rates, customer satisfaction scores, and fiber consistently comes out way ahead. The advantages are clear and measurable.
Okay, so higher revenue, more loyalty. Is there a less visible but maybe equally critical financial benefit? What about the day-to-day costs of running the network? Operational costs.
Absolutely. That's a huge piece of the puzzle. Fiber has dramatically lower operational expenditures, OpEx, compared to copper. Think about it. Copper networks are complex, active systems. Lots of electronics needing power out in the field, susceptible to weather, water damage, just plain aging.
Taking lots of repair calls.
Constantly. Expensive truck rolls, sending technicians out. A passive optical network, PON, is much simpler. It's mostly just resilient glass fibers, immune to electrical interference, far less prone to physical issues.
So fewer breakdowns, fewer calls.
Way fewer service calls, substantially lower maintenance costs over the decades-long life of the network. These OpEx savings are crucial for long-term profitability and just make fiber a much more efficient asset to own and operate.
So higher revenue, lower churn, and lower operating costs. That combination fundamentally transforms the whole ROI picture, doesn't it?
Completely. Those daunting 11-plus year payback periods that looked so scary back in 2015, they are now significantly compressed. Companies aren't always public with exact ROI figures, but you hear it in their earnings calls. AT&T in Q3 2024 explicitly said their fiber investment is generating attractive returns with improved operating leverage.
That's a massive shift in financial reality and explains why they're all scrambling to build it out now.
And it's not just a financial shift, it's a complete strategic repositioning. The whole narrative from the top executives has changed. It's all fiber first now.
How so? How has the commentary changed?
Well, if you look at earnings call transcripts from, say, before 2015, executives might talk about UVerse or Fios as just one part of a bigger portfolio, often overshadowed by the excitement around wireless growth.
But now, post-2020.
Now, fiber is positioned as the foundational platform for the entire future of the business. AT&T's whole strategy is framed around converged connectivity through 5G and fiber, and they explicitly call fiber the driver of attractive returns, Frontier's turnaround story. Their Q2 2024 call attributes their growth directly to record fiber broadband net adds.
The language has totally shifted. It's not just a product, it's the core infrastructure.
Precise.
And a crucial part of this new strategy, our sources highlight, is this symbiotic relationship between fiber and 5G wireless. How do those two work together? They seem different.
They seem different, but they're not competitors. They're deeply intertwined, mutually reinforcing. Think about 5G. To get those ultra-high speeds and massive capacity, it uses high-frequency spectrum.
Okay.
But that high-frequency spectrum has shorter range, doesn't penetrate buildings as well. So 5G requires massive densification. You need thousands upon thousands of small cells, little antennas placed on utility poles, building rooftops, everywhere, especially in cities.
Right, you see them popping up.
But each of those small cells needs a high-capacity connection back to the main network. That's called backhaul. And only fiber can reliably provide the multi-gigabit capacity and ultra-low latency that 5G small cells demand.
Ah, so the 5G antennas need fiber connections.
Essentially, yes. A quote from the sources sums it up perfectly. A 5G network is a fiber network with wireless endpoints. You can't really have a high-performing 5G network without a deep fiber network supporting it.
That's a powerful way to put it. Does building them together save money?
Oh, huge cost savings. Trying to build two separate parallel networks, one for home fiber, one for 5G backhaul, would be incredibly expensive. But by planning for both uses from the start, deploying fiber that can serve both homes and small cells, operators can cut the total deployment cost by a staggering 65% to 96% compared to building them separately.
Wow. So the home internet revenue helps pay for the 5G rollout and vice versa.
Basically, yes. It's a much smarter way to allocate capital strategically. A real win-win.
And beyond connecting homes and 5G towers, does this ubiquitous fiber network open up other doors, new revenue streams, moving beyond just being the dumb pipe?
Absolutely. That's a huge part of the long-term vision. The same fiber-passing homes can easily serve nearby businesses, offering things like dedicated internet access, high-speed point-to-point connections, sophisticated SD-WAN services.
Which businesses pay more for?
Typically, yes. Higher margins in the enterprise market, plus they can become a carrier's carrier. They can lease fiber, either dark fiber, just the glass strands, or lit services to other mobile operators who need it for their own 5G backhaul, but don't have their own fiber everywhere.
So they sell capacity to their competitors.
Exactly. It's a significant wholesale revenue opportunity. That global 5G wireless backhaul market is projected to hit over $5.7 billion by 2030. Fiber owners are well positioned to grab a piece of that.
Any other applications?
And then there are smart city applications. Fiber becomes the essential nervous system for things like intelligent traffic lights and transportation systems, smart street lighting, public safety networks, remote utility monitoring, creating entirely new partnerships and revenue models with municipalities.
It sounds like the sheer scale and pace of this fiber build has also forced a massive operational transformation inside these companies. They're not just building, they're having to build faster and smarter. How?
They've had to adapt, definitely. The physical process of deployment has evolved. They're leaning heavily on advanced data analytics and AI-powered planning tools now.
AI for planning where to build.
Yeah, these tools analyze everything: population density, income levels, locations of existing infrastructure, competitor footprints, even labor costs to figure out the most efficient and profitable sequence for new deployments, optimizing the build strategy.
And using things like that microtrenching you mentioned.
Right. New construction methods like microtrenching allow for faster, less disruptive installation, getting fiber in the ground much quicker than the old ways.
And are they doing all this work themselves or relying on partners?
To hit these aggressive build targets, they're moving away from doing everything in-house. They're embracing strategic partnerships and outsourcing much more. We mentioned joint ventures like Gigapower.
Sharing the cost and risks.
Exactly. They're also forming long-term partnerships with specialized engineering firms, construction companies, even asset recovery firms to handle the physical build-out more efficiently, leveraging expertise.
But surely, finding enough skilled workers for this massive effort must be a challenge.
A bottleneck.
That's a critical point, yes. The availability of a skilled workforce, splicers, technicians, is indeed a major bottleneck. The industry knows this and is heavily focused on workforce development.
Now, training.
Both retraining existing copper technicians, giving them the new skills for fiber, and building entirely new talent pipelines through partnerships with community colleges, technical schools, and organizations like the Fiber Optic Association. It's essential to have the people to not just build these networks, but maintain them long term. So, with this massive rewiring well underway, what are the broader lessons we can take away? Thinking about the next generation of big infrastructure projects, and what does the future of connectivity look like now?
Well, it's clear this current fiber deployment isn't the end game. It's really the creation of a new foundation for competition. And there are some powerful lessons here for any generational infrastructure investment.
Like what?
First, the undeniable power of catalytic competition.
You mean the Google Fiber effect again? How one relatively small player forced the giants to react?
Exactly that. Google Fiber, even with its limited footprint, really did shatter the prevailing consensus.
Mhm.
They offered speeds and prices the incumbents initially dismissed as niche or unsustainable. But it forced the established players to react. It shows that the mere threat of new competition, even if limited, can be an incredibly powerful driver of investment and innovation. Sometimes it just takes one disruptor.
And this whole story also really highlights the interplay between government policy and private investment, doesn't it? That symbiosis.
It's a fascinating dance. The vast majority of the money, the capital, has come and will continue to come from the private sector. Driven by market forces, the better business case now.
But the government funding.
But that targeted public funding bead, RDOF, was absolutely essential to de-risk the deployments in those really high-cost, mostly rural areas, made the business case viable where pure market forces alone had failed for decades. Policy acted as a catalyst to unlock private investment, shows how government and industry can partner effectively on huge national goals.
It also makes you think about timing, technology cycles, and strategic patience. Verizon's Fios, launched way back in 2004, was visionary,
Absolutely visionary.
but arguably ahead of the mainstream demand curve, right? They were pioneers, but maybe too early.
That's a great point. They bore the significant cost of educating the market, proving the technology works at scale, all at a time when very few people actually needed gigabit speeds, and the cost to deploy fiber was much higher.
So later investors benefited.
Yeah, later investors like AT&T, with their massive builds starting around 2020, benefited from more mature, cheaper PON technology, crystal clear demand signals from streaming and COVID, and a much more supportive policy environment with federal funding. It's that tricky balance between being a first mover and a fast follower. Sometimes the fast follower with better timing wins big.
Okay, looking ahead now, the competitive battlegrounds are clearly shifting. If gigabit speeds are becoming the new normal, the baseline,
Well,
what's next? Where does the competition go?
it's already shifting way beyond just offering a gigabit. Competition is moving to multi-gigabit services. Google Fiber's marketing 2 gig, 5 gig, even 8 gig symmetrical speeds in some places. They're testing 20 GBPs.
20 gigs to the home.
Right. So the differentiator won't just be having fiber. It'll be about the quality, the reliability, the super low latency, and especially that symmetrical capacity, fast uploads as well as downloads. That's crucial for the next wave of applications. AR/VR, cloud gaming, advanced AI running locally or in the cloud.
And fiber is the only thing that can really deliver that consistently.
It's the only fixed line technology today that can scale to meet those demands reliably.
Now, what about this other big competitive force that's popped up recently? Fixed wireless access, FWA. Using 5G for home internet, where does that fit in?
FWA has definitely seen explosive growth. Verizon, T-Mobile, adding hundreds of thousands of subscribers each quarter. It's often cheaper, super easy to install, no technician needed.
So is it a threat to fiber?
It's important to understand it's not really a direct replacement for fiber in terms of capability. FWA relies on shared wireless spectrum. That means its capacity is ultimately finite and can be affected by network congestion, just like your mobile phone signal can slow down sometimes.
So fiber still has the edge on performance.
Fiber remains the premium highest capacity solution with virtually unlimited bandwidth potential. FWA is more of a robust competitive check on price, especially in areas where wireline options were limited or maybe too expensive. It provides a good alternative, pushes fiber providers on price, but they serve slightly different needs and market segments.
Okay. Now, despite this huge surge in fiber building here in the U.S., how do we stack up globally? Are we catching up to the leaders?
That's an interesting point. Despite all this recent activity, U.S. FTTH penetration, the percentage of homes where fiber is actually available, was still only around 30% as of 2023.
Only 30%. Who's leading?
We still lag significantly behind global leaders like South Korea, which is nearing 89% penetration, or Japan at around 86%.
Wow. Why are they so far ahead?
Well, factors like population density play a role, but our sources also point squarely to strong, early, and sustained government policies in those countries that actively promoted competition and infrastructure investment over many years. Table 4 in the sources shows this comparison.
So it tells us there's still a lot of runway left for fiber deployment here in the U.S., but also that policy choices really matter long term.
Absolutely.
So what does this mean for policy going forward to make sure we actually get the full benefits of this huge upgrade? What are the key recommendations?
Well, first, policymakers need to ensure efficient and accountable use of all that subsidy money. especially the massive BEAD funding. That means robust verification. Audits like the FCC's Rural Broadband Accountability Plan to make absolutely sure that high-quality, future-proof networks are actually getting built with taxpayer dollars, and the money isn't wasted or misdirected.
Hold them accountable for results.
Exactly.
And beyond the money, what about those other barriers? The permits, the polls?
Right. Secondly, there needs to be a continued focus on reducing those deployment barriers, making Dig Once policies universal, streamlining permitting at all levels of government, ensuring fair and timely access to utility poles and existing conduit. These non-financial barriers can be just as effective as subsidies in lowering costs and speeding things up, making it easier to build.
Makes sense. And finally, competition. It seems like that was a key driver.
Absolutely critical. So thirdly, policymakers should continue to promote competition wherever possible and maybe encourage more exploration of open access models.
Where the network owner leases to multiple providers.
Yeah. One entity owns the physical fiber, but multiple retail ISPs compete for customers over that shared infrastructure. That tends to increase consumer choice, put downward pressure on prices, and spur innovation on services. Ensures the benefits get spread more broadly.
Ultimately, though, our sources suggest the real long-term value of having fiber everywhere lies in its inherent optionality. They call it a future-proof asset with nearly unlimited capacity. What does that mean for you, the listener?
It means this fiber network is a platform for applications and services that have not yet been invented. Think about it when the internet first started. Who imagined streaming 4K movies or real-time global video calls?
Nobody.
Fiber provides that foundational layer, that almost limitless bandwidth runway that allows for entirely new digital experiences, exponential growth in data use, these we probably can't even conceive of today.
So the companies controlling this foundational layer, they're the ones best positioned to capture the value of future technological innovations. This massive investment isn't just a bet on faster broadband today.
No, it's a bet on the future of everything that will be built on top of it.
Absolutely. The great rewiring of America from copper to glass. It's clearly more than just an infrastructure project. It's a fundamental shift that's reshaping our digital world and opening doors to a future we're only just beginning to glimpse.
A very different future, potentially.
And that brings us to our final provocative thought for you to mull over. Consider this. With fiber now forming the very backbone of our digital world, what previously impossible innovations might be unlocked for you in the next decade? Are we truly on the cusp of a new digital age where the only limit is our imagination, not our connection?
Think about your own internet use, your daily digital life. How does knowing this deeper context, this history, this massive shift, how does it change your perspective on something you probably use every single day without a second thought? We encourage you to reflect on that.
Thank you for joining us on this deep dive into the incredible transformation of America's telecommunications infrastructure. We hope you feel a little more well-informed and maybe a little more excited about the connected future. We'll see you next time.